How do you find a good stock? Imagine if you could identify a great potential stock right now, invest in it, and make a huge profit, achieving financial freedom in the process. Wouldn't that feel amazing? Have you ever wished you had bought a stock before it skyrocketed? But let's be honest, finding a potential stock is easier said than done. Stock analysis is a vast and complex system. But don't worry, no need to panic. In this hardcore educational session, we're going to dive into the process of finding a reliable potential stock. No more small talk, let's get started. When it comes to finding potential stocks, the core idea is simply to identify a company with strong long-term profitability. There are countless frameworks, methods, and metrics for analysis, but the essence is surprisingly straightforward. I summarize it as the core 3+1. The 3 refers to 3 quantitative indicators. The 1 refers to 1 qualitative, non-quantitative factor. These 4 aspects must be considered together. In fact, selecting a company feels a lot like choosing a life partner, don't you think? When you meet someone in a date, the first thing you ask might be, "What do you do for a living? How much do you earn?" See? Getting straight to the point about income. And it's no different when we evaluate a company. The first and most crucial aspect to look at is income. This brings us to the first indicator, the company's profitability. The simplest way to measure profitability is through key metrics like gross profit margin, net profit margin, or operating profit margin. If you had to focus on just one, the most common choice is net profit margin, calculated by dividing the company's net profit by its total revenue. For example, imagine 2 bubble tea shops. Street Bubble Tea sells a cup for $10. After deducting all expenses like rent, wages, and materials, it earns $1 per cup, giving it a 10% net profit margin. My bubble tea shop sells a cup for $20 and earns $10 per cup, resulting in a 50% net profit margin. Now, which one is better? From a consumer's perspective, you'd probably prefer the street shop. It's cheaper, and 90% of the cost is spent on actual ingredients and operations. But from an investor's perspective, my shop is far more attractive. Why? Think about it. My shop doubles the cost to $20, yet people still buy it. This shows it has a unique edge like strong branding or quality, which allows it to charge premium prices. If costs suddenly rise, for instance, milk prices, rent, or wages, the street shop might struggle to stay afloat due to its thin margins. But for my shop, with its high profit margin, the impact would be minimal. At worst, it might lose a bit of profit, but its business would remain stable. This ability to absorb rising costs and withstand risks makes high profit margin businesses incredibly appealing to investors. So, how do we decide what's good or bad? Profit margins vary significantly across industries due to different operating models. To assess a company's profitability effectively, compare its net profit margin to the industry average or similar companies in the same sector. This context gives the number real meaning. For instance, looking at Chinese and US stocks, most companies' net profit margins are generally in the 5% to 10% range. However, industries like finance, semiconductors, software, tobacco, and pharmaceuticals often achieve margins in the double digits, sometimes even exceeding 20%. Because profitability is so crucial, most stock analysis tools or websites include this metric. You can try looking it up yourself to see how the companies you're interested in compare. Take Apple, for example. Its net profit margin is a staggering 25%, while many competitors in the same industry struggle with single-digit margins. In such a fiercely competitive market, this number is truly astonishing. Sure, people often complain that Apple products are overpriced, but that doesn't stop customers from buying them. The numbers speak for themselves. On the flip side, imagine a company with a great reputation, image, and brand, but it's just not making money. As a consumer, you'd probably love it and happily buy from them. But as an investor, you'd need to think twice and be cautious. Another point to consider is high-growth companies, like many internet businesses. These companies often burn cash on subsidies, research, and expansion to rapidly grow their user base. In such cases, their net profit might even be negative, leading to a negative profit margin. Some might ask, if their profit margin is negative and they're growing fast, should we ignore them and not invest? The answer is, of course not. This is where you need to think critically. You can't rely solely on one number. For companies in this situation, look at their gross profit margin, the profitability after deducting only direct costs. This can give you a better idea of their potential and how they compare to competitors. All right, we've covered profitability. So what's next? Think about dating again. What's the next question after asking about income? Do you have a house? A car? Oh, and did you buy them with loans? If it turns out you don't have many assets but are drowning in debt, your date's eyebrows might start to furrow. In simple terms, it's about checking your financial health. For a company, this translates to assessing its financial stability, how healthy its assets, liabilities, and overall balance sheet are. When it comes to financial health, the numbers don't have to be sky-high to prove excellence, but if they're too low, it's definitely a red flag and very risky. One of the most common indicators is the current ratio, which is straightforward to calculate. Current ratio equals current assets divided by current liabilities. The bigger the ratio, the more assets the company has to cover its short-term debts, indicating better financial health and liquidity. If the ratio is less than 1, it means the company might not be able to pay off its debts within a year, which is a serious concern. So, when evaluating companies, make sure their current ratio is greater than 1, and ideally, above 1.5 for added safety. All right, we've confirmed that this candidate not only makes money but is financially healthy. What a perfect candidate. Now comes a key question. How popular are they in the dating market? Great people never lack admirers, but you also don't want someone surrounded by too much competition. The same applies to the stock market. You don't want to invest in a stock that's been overhyped and overpriced. This leads to an important principle. A good company doesn't necessarily mean a good stock. Looking at the two indicators above, the company seems solid. But if it's a good company, we'd want to buy it at a reasonable price. One of the most common metrics for this is the PE ratio, price to earnings ratio, calculated as PE equals stock price divided by net earnings. Simply put, you can think of it as the number of years it would take to recoup the stock price through earnings, ignoring discount rates and other complexities. The lower the PE, the cheaper the stock appears relative to its earnings. But again, this varies significantly across industries, so it's not universally comparable. For example, many high-growth internet companies have negative earnings, making their PE meaningless. All right, we've covered the quantitative aspects. Now let's move on to those that can't be measured by numbers. The 1 in the 3+1 core indicators refers to a qualitative factor that might be even more important than the numbers we just discussed. So listen closely. This is about the company's moat. Sometimes called barriers to entry, core competencies, or competitive advantages. A company's moat determines whether others can easily copy its business model once it's proven profitable. The question is, how can this company maintain its edge and stay unbeatable? Here's an example. Suppose my bubble tea shop launches a new product called Spicy Pearl Milk Tea. The pearls have chili-infused centers, making them delicious, exciting, and even great for pranks. It becomes wildly popular and customers line up to buy it. Do you think I've discovered a game-changing secret? Not really. If making these pearls is easy, any neighborhood bubble tea shop can replicate it. Without a moat, my unique selling point wouldn't last, and competitors could easily take over the market. If everyone starts offering the same spicy pearl milk tea, it will inevitably lead to a price war. Even if you invent a great product, it doesn't automatically become your moat. But if I'm smart enough to patent my spicy pearl milk tea, the story changes. Anyone who wants to make it will need to pay me patent fees. That creates a strong moat, a barrier that others can't cross easily. Now, I can sit back and make money without worrying about competitors flooding the market. The point here is that a strong moat is critical for a company's long-term profitability. Common moats include, first, brand. This is a powerful moat, especially in consumer goods and retail. A strong brand adds unique value beyond the product itself. For example, people choose Hermès, Ferrari, or Lafite not because they're discounted or cheap, but because of the brand prestige. Even if prices rise year after year, people still buy them. Giving these products as gifts earns recognition and appreciation, thanks to their branding. This is the branding effect, a strong moat for companies like Apple, where the product represents more than its functionality. Second, network effects. This moat occurs when a product or service becomes more valuable as more people use it. Once it reaches a certain scale, growth becomes self-reinforcing, creating a powerful moat. For examples, Instagram. Its core function, communication, isn't unique. Any tech company could create a similar app. But why do people download Instagram? Because everyone else uses it. Switching to another app means losing your social circle, making Instagram's network effect its strongest competitive edge. Also, the video platforms. Creators upload content, attracting more viewers. As more viewers join, more creators upload content, creating a feedback loop that drives growth. This moat is particularly common in internet and platform-based companies, where markets often have a winner-takes-all dynamic. The leading company can dominate 60 to 70% of the market share. That's why platform companies often burn cash upfront, buying ads, offering subsidies, and aggressively acquiring users to establish a network effect and secure their moat early on. Another common moat is customer stickiness, sometimes referred to as switching costs. The idea is simple. As a consumer, you might not think the product or service you're using is significantly better than others, but you stick with it because you're used to it and don't want the hassle of switching. For companies, this means once they've acquired you as a customer, you're unlikely to leave, providing them with stable, long-term revenue. However, this type of moat is relatively weaker compared to branding or network effects. For examples like telecom providers, switching to a new phone plan or Wi-Fi provider can be annoying and time-consuming. If the service is decent, most people won't bother changing. Credit cards. Many users stick to their existing cards simply because it's a hassle to apply for and update all their auto payments with a new one. Gym memberships or beauty subscriptions. These services often lure you in with significant discounts or promotions at the start, like first-year free months or introductory rates. Once you're on board, it's easier for the company to retain you. This kind of moat allows companies to spend heavily upfront to attract customers, knowing they'll stick around long enough to offset the initial costs. There are also some obvious moats that are easy to recognize at a glance. Examples include unique patented technology, licenses that are difficult to obtain, like government approvals or limited permits, high upfront investment costs that deter new competitors. However, truly understanding a company's moat isn't easy. That's why it's essential to focus on industries you're familiar with. You need to understand how a company operates, how it makes money, and what gives it a competitive edge. Without this knowledge, you're just following the crowd, making yourself vulnerable to market manipulation. In summary, this is my core 3+1 framework for finding potential stocks. When selecting stocks, take a comprehensive view. Avoid chasing short-term gains and focus on long-term value. If you found this video insightful, please like, share, and subscribe to the channel. Don't forget to hit the notification bell so you won't miss our next deep dive into the world of finance. Thank you for listening, and I'll see you in the next one.